Welcome to this edition of Stock Market Pulse. My name is Eric, and today is Wednesday, March 30th, 2016. If you haven't done so already, be sure to subscribe to the YouTube channel for more videos and strategies. So let's take a look at the SPY. Interesting week. We had obviously the news of the week. If you haven't heard already, Janet Yellen had a speech, was uber dovish, which is actually very surprising. This actually caught a lot of people off guard, me included, because last week some of the other Fed guys were out and they were, relatively hawkish. So last week we kind of got the pause. We waited for the Fed announcement, and as of today, we had a rally yesterday and we rallied up today as well. If we take a quick look at this on the daily chart, you can see here was yesterday's announcements. We rallied up until we kind of gapped up, put in a little bit of a doji here. We're definitely, overbought on the daily chart, but, I don't think that it's impossible for us to get to 210 over the next few days. I do think there are going to be some headwinds here. I want to go back to the weekly chart and point out a couple things. So first, on the weekly chart, in last week's video, I pointed out the last few times that the oscillator was up 5 weeks in a row, the DMI oscillator on the weekly chart, we had some sideways action to a pullback. Now, obviously, that's sort of defying the history of that, in this moment. But we have a couple other things going on this week, and I really think that you probably need to be prepared for this. If you're a bull right now, then obviously you're just going to want to tighten your stops, and if we roll over, we roll over. If you're a bear, I think you need to be careful here, but I do think you should start considering bearish positions. And what I'm going to be looking at is a bear call spread on the SPY. I'm not going to put it on. I might put it on tomorrow. Excuse me, I didn't put it on today. I might put it on tomorrow because basically the Fed is saying there's going to be low rates for a long time. But we do have a jobs report on Friday, which is also the first day of the month. So that's going to be kind of a mixed day. But what happens is around 30 days before earnings season, which is going to kick off next month, the corporate buybacks are going to dry up a little bit. So I think that, any sort of, I think if the jobs report is really, really positive, that's going to sort of push the Fed to raise rates sooner, which I think ultimately is going to cause some kind of pullback. Now, I don't want to directly short the market here. I don't want to just buy puts. I think that's sort of, a little bit careless unless you get a signal. But what I will say is I want to look at selling some bear call spreads, and I'm specifically looking at the 210, 214. Now, I'm going to actually go out to May. There's 51 days left to May. And the reason why is because you get a lot of time decay more in the last 30 days. But if you can start at 50 days and buy the spread back when there's about 20 days left, you can actually collect a pretty decent amount of premium. We do have some room built in if the market were to sort of rally up here. The question is, do you think the market is going to break out to all-time highs heading into, April corporate buyback dry up season as well as earnings? I don't think it is. So I'm willing to go in and sell the 210, 214 bear call spread. As of right now, that's going for about $1.25. You can sell for $1.25. Your risk would be 275 per spread because it's the difference in the strikes. In this case, $4 minus $1.25, you end up with 275. Now, if we were to rally really, really hard tomorrow, I may look to try to get around the same credit somewhere. I basically want about $1 credit. So I could go out a couple more strikes. If we were to rally tomorrow, let's say we rallied up to, let's just call it 208. This spread's going to be worth more. So I may go out to a 211, 212 to give myself a little bit more room. So that's what I'm looking at heading into the jobs report Friday. The other thing you can do, and I've started doing this as well, is I've started picking up some VXX with the idea that we're starting to sort of, trade sideways here a little bit. I mean, it's a pretty big range, and VXX is not a long-term vehicle. But I do think if you're not an options trader and you want to have a little bit of protection into the jobs report, if you can get into the VXX around, let's call it 17, maybe 16 and change. If we rally tomorrow, this will probably come in a little bit, and just look to hold VXX into the jobs report and really just expecting some volatility. So that's another way you can play a potential short trade. This is a little bit harder to sort of weave in and out of the VXX. I think the easier, safer play is the bear call spread on the index, but this is also something that you could look into, and I would look for a rally into tomorrow and then probably a sell-off in the afternoon waiting for the jobs report. So I'm looking for Doji Day tomorrow. That's all I got today. You guys have a great night, and I'll see you at the next update.